So glad you could join us today on a Monday morning. I'm Marlon Bowling with you, your tour guide to the ag commodities. Well, Tammy and I talked about it when we came on the air this morning. It was probably going to be an adventure today, and so far, well, it hasn't disappointed in that regard. Let's take a look at what some of these quotes are doing. Our quotes are from bar chart. Let's go ahead and take a look at this corn market here first. And on the big board, we have September, well, now just a penny and a quarter lower at 4.73 and a quarter. Gosh, if you were with us when we came on the air, it was down about 7 on the open. We have December corn now just a penny and a half lower at 4.85 and 3/4. Now remember, overnight, the market was maybe a penny lower, if that. And then right before the close overnight, we finished up about 4 lower on the corn, and now it's starting to rebound again. So you can't figure this one out. Soybeans, well, they've just been pretty strong all the way along. They closed overnight with about, I don't know, a 10-cent gain or so, something like that. And now you have September soybeans up 18.5 at 13.55 and 3/4. Well, heck, we're only a penny and a half from our high of the day now. Remember, we had that overnight export sale of soybeans to unknown destinations, over 400,000 tons. November up 18 3/4 now at 13.26 and a quarter. Well, can the wheat market turn around? Because it was getting squashed early on. Nah, it's still kind of getting squashed. In Chicago, let's go with that. September down 16 at 6.10 and 3/4 after an overnight high of 6.35. My goodness, they whacked another 25 cents off of that from last night's high. In Kansas City, we're down 19 on September at 7.36 and 3/4. So that one is also a fair amount off of its overnight high. It looks like we're off of that by 25 cents right now, 24 cents. Let's take a look at Minneapolis wheat. Here you have the September contract 6 lower at 8.09, just a couple of pennies from our low of the morning trade so far. Well, let's bring in Chris Swift over here. He's a long ways away. You're about
right
4 feet away from me here. He's with Swift Trading here in Nashville. Yes. Thanks for coming in.
Absolutely.
Nice to have you on set.
That's a pleasure.
So we have a mixed bag here on the open here on a Monday. What do you make of this? Why do we have corn and wheat going one way and beans the other?
Well, I think USDA told us exactly why on Friday. Well, both the corn and the soybeans came in just a little bit lower than last month, the expectations on it. And then it's just the sheer number of acres. We've got 4 million more acres of corn, 2 million acres less of soybeans. So clearly the yield is going to be less important with what is the beans. It's going to be much more important on, less important on the corn and much more important on the beans just because of the acre spread that we have between the two. And then every time you see it rain somewhere, because we grow wheat just about every region there is in the United States, that's in for the wheat planting. So we know that, as we get more and more moisture coming in, we're going to plant more wheat.
Probably, from what I understand, too. What about on the corn, though? I mean, there were so many areas out there in the plains and southern plains where it just burned up. Mm-hmm. Dryland corn,
right, right.
And they've been chopping a lot of dryland corn out there. They say there's not much grain in it. Is that going to be reflected eventually on the USDA numbers? I mean, that
probably eventually. It'll come down in the yield, so the yield aspect of it maybe come down another bushel and a half an acre or something like that. But pretty much everything's already done for the corn. So I think with the crop progress report showing the condition that it is in, plus, we know we got the 4 million more acres, and USDA was very gratuitous to it, keeping that yield up where they did. And then for the soybeans, they knocked it down just a little bit more. And I think the soybeans are the real market to watch because we've seen the spreads deviate between corn and beans for consistently now for 5 or 6 months. No reason to think that shouldn't be like that.
Do you think that move today is because of the weather outlook further down the road?
I think it's demand, believe it or not. I think we see energy prices continue to move higher, and we're not seeing any kind of policy changes that would increase our energy production or make any better ways with our foreign adversaries that we try to buy oil from. So everyone out there is kind of on their own for their energy production, and ours is very weak. And so we're going to see higher prices, and with grains a portion or a percent of energy, there's really no reason not to see them move up in the same manner.
Did you see the dollar index this morning?
I did, yeah, up sharply.
I mean, well, maybe we can bring that up here, but there it is, 500 points higher again, September at 103.200.
It's been cooking.
that isn't going to help the grain, is it?
Probably not going to help them, but you know, if you kind of think about it, I've heard this expression for the dollar is probably just the prettiest horse in the glue factory. So that's why it's doing it. There's not really a great deal of movement in the currency market. So the United States is really not in much better shape than any of the others. So it just happens to be the prettiest one.
Okay, we'll come back in just a moment. We'll take a look at our livestock trade, see what's going on there right after these messages. Okay, we're talking with Chris Swift of Swift Trading. And now let's dive into our livestock trade on a Monday morning and see which direction they want to go here. They were pretty flat on the open, and right now it's not a ball of fire. You have October live cattle 25 cents lower at 181.07. December down 22. We're at 185.22. So very, very quiet, just a little bit weaker here on the open. In feeders, you have the September contract now 95 cents lower at 250.50. So they're taking a little wind out of the sales here. October down 55 right now at 252.32. So weaker at this point in the cattle complex across the board. Lean hogs, well, they're joining the party to the downside. You have October down $1.90 at 79.42. Chris, that's way under that $80 mark now. And December down 152 at 72.97. How much trouble is that lean hog market in on the downside yet? How much risk is there?
Well, we've seen a lot of aspect from the lean hog index. It's been coming down a little bit, and the pork cutout's been coming down just a little bit. So I'm not real sure. This is a very difficult time, seasonality for hogs. They can do a great deal of everything, and as we've already seen, they're stuck in about an $8 trading range and have not been able to break out of that range just yet.
You know, we were talking earlier about the way the formation is on the chart for live cattle right now, and it just seems like it has kind of peaked out. Just keeps bumping up on that plateau there. So you're going to have to break out one way or the other here pretty soon, or what?
There's an expression in the grain market. You got to, at some point in time, pin the tail on the donkey. You got to market that inventory. And I think we look at the cattle market and see this price up here and they're not really moving higher. And I think there's people pinning the tail on the donkey and saying, let's just market some inventory up here. And if it goes higher, that's great. We'll make do with whatever happens after that. But right now, we go by the same adage of buy low and sell high, and we're pretty high in cattle prices right now.
We're not too far away from another cattle on feed report, right?
About another week. I think it's in the next week.
So what do you expect to see when that report comes out this time around?
Probably a few more placements. We still had to move a lot of cattle because of the heat in the month of July, so I think you'll see a little bit heavier placements on there, probably a continuation of more heifers into the mix there. Cow slaughter has slowed down tremendously now. And we've kind of reached this point where both consumers, packers, everyone is just sitting here dealing with higher prices, and we're getting kind of tired of it. And when we get tired of things, we tend to slack off just a little bit from them.
The important thing to remember is we're going to be comparing to the numbers a year ago.
Oh, yeah, absolutely.
And that was a little unusual, too, a year ago, right?
Yep, absolutely.
So what does that alter your perception any for
Not
this
really.
year or not?
No, not really. We pretty much held 3 to 4% lower on everything from the herd size to the placements, cattle on feed. I don't see any changes just yet. We probably got another 6 or 7 months of production before we start to see anything come about this spring. And this spring, we'll begin to see probably some new bursts and probably no expansion, but maybe a very sharp slowdown in liquidation.
All right. Well, thanks for coming in. Appreciate that.
Always a pleasure.
Chris Swift of Swift Trading with us here. He is from Nashville. Tammy, back to you.